The world of finance has been shaped by numerous crises and crashes throughout history. From stock market crashes to housing bubbles, these events have had a significant impact on the global economy and continue to influence the way we think about finance today. In this video, we will introduce some of the best-known crashes in history. The Dutch tulip mania of the early 1600s. The Dutch tulip mania, also known as tulip fever, was a period of intense speculation in the Netherlands during the early 17th century. The craze centered on the market for tulip bulbs, which were a new and exotic commodity at the time. This period is often cited as one of the first recorded speculative bubbles in history, with prices soaring to astronomical levels before crashing dramatically. The origins of the tulip mania can be traced back to the late 16th century when tulips were introduced to the Netherlands from the Ottoman Empire. The exotic nature of the flower, coupled with the fact that it was difficult to cultivate, made it highly sought after. As demand grew, prices began to rise, and by the early 17th century, tulips were being traded on the Amsterdam Stock Exchange. At the height of the mania in 1637, tulip bulbs were selling for prices that were equivalent to 10 times the annual salary of a skilled craftsman. Some of the rarest bulbs could sell for as much as a small house. However, the market soon collapsed, and many investors lost everything they had invested. The reasons for the collapse of the market are complex and not entirely clear. Some argue that it was due to the outbreak of the bubonic plague, which reduced demand for luxury items such as tulips. Others suggest that it was due to overspeculation and the fact that many investors had purchased tulip bulbs on credit. When prices began to fall, they were unable to pay back their debts, leading to a domino effect of bankruptcies. Despite its relatively short-lived nature, the Dutch tulip mania has remained a fascinating case study for economists and historians alike. It serves as a reminder of the dangers of speculative bubbles and the importance of rational decision-making in financial markets. Today, the term tulip mania is still used to describe situations where asset prices rise to unsustainable levels due to hype and speculation. The South Sea Bubble of 1720. The South Sea Bubble was one of the most significant financial crises in history, which occurred in 18th century Britain. It was caused by the South Sea Company, a trading company that had been granted a monopoly on trade with Spanish colonies in the Americas. The company issued shares to investors, promising huge profits from the trade, which led to a massive speculative bubble. In 1720, the bubble burst, causing a financial panic and ruining thousands of investors. The South Sea Company's shares plummeted, and many investors lost their fortunes. The government had also invested heavily in the company, and its collapse had a significant impact on the country's finances. The South Sea Bubble was fueled by the desire for quick profits and the belief that the company's monopoly would bring vast wealth. However, the company's actual profits were far lower than expected, and it had taken on significant debt to finance its operations. The collapse of the South Sea Bubble led to significant reforms in British finance, including stricter regulation of joint stock companies and greater oversight of the stock market. It also contributed to the rise of the Bank of England as a central bank and increased government oversight of the economy. Overall, the South Sea Bubble remains a cautionary tale of the dangers of speculative bubbles and the need for responsible financial regulation. It serves as a reminder that market excesses can have real-world consequences and that investors should be wary of get-rich-quick schemes. The Mississippi Bubble of 1720. The Mississippi Bubble was a financial crisis that occurred in France in the early 18th century. It was caused by a speculative investment scheme by Scottish economist John Law, who had been invited to France to help reform the country's finances. In 1716, Law founded the company d'Occident, a company that was granted exclusive rights to trade in French colonies in North America and West Africa, as well as the monopoly on the French tobacco trade. In 1719, the company was merged with the Compagnie des Indes, which had exclusive rights to trade with the East Indies, to form the Compagnie Perpetuelle des Indes. The company's shares were sold to the public at inflated prices, and soon became the talk of Paris. The company's monopoly on the tobacco trade and its access to the vast resources of the French colonies made it seem like a surefire investment. People from all walks of life, including nobles and clergy, invested heavily in the company's shares. However, the company's success was short-lived. In 1720, the company's shares began to fall in value, and investors panicked, causing a run on the bank that law had established. The bank was unable to meet the demands of its depositors, and the French government was forced to step in to save the financial system. The company Perpetual des Indes was dissolved, and law was forced to flee the country. The Mississippi bubble had a profound impact on the French economy and society. The collapse of the company Perpetual des Indes wiped out the savings of thousands of investors, many of whom were members of the French nobility. The crisis also contributed to a general sense of disillusionment and cynicism towards the financial system, which lasted for many years. The Mississippi bubble also had a wider impact on the global financial system. The collapse of the company Perpetual des Indes was felt far beyond France, and contributed to a broader period of economic instability and financial crises in Europe in the 18th century. In conclusion, the Mississippi bubble was a financial crisis that occurred in France in the early 18th century. It was caused by a speculative investment scheme by John Law, who had been invited to France to help reform the country's finances. The Wall Street crash of 1929. The Wall Street crash of 1929, also known as the Great Crash, was a catastrophic stock market crash that occurred on October 24, 1929, and marked the beginning of the Great Depression. The crash had far-reaching consequences and resulted in a prolonged period of economic hardship for the United States and other countries around the world. The stock market boom of the 1920s, also known as the Roaring Twenties, had seen an unprecedented rise in share prices and a surge in investor confidence. This period of prosperity was fueled by a booming economy, with new technologies and industries emerging and consumer spending on the rise. The growth in the stock market attracted a large number of investors, including many ordinary Americans, who saw the stock market as an easy way to make money. However, in the summer of 1929, signs of economic trouble began to emerge. Industrial production began to slow down, and consumer spending decreased. Companies started reporting lower profits, and the stock market began to decline. Despite these warning signs, many investors remained confident, and the stock market continued to climb. On October 24, 1929, known as Black Thursday, the stock market finally crashed. Panic selling set in, and the market plummeted. Investors who had borrowed heavily to invest in the market were forced to sell their shares to meet their obligations, further exacerbating the decline. The next week saw further declines, with Tuesday, October 29, 1929, known as Black Tuesday, marking the largest single-day drop in the market's history. The effects of the crash were devastating. The stock market lost an estimated $30 billion in value, and thousands of investors lost their life savings. Banks and businesses that had invested heavily in the stock market also suffered significant losses. The crash triggered a wave of bank failures, and the credit markets dried up, making it difficult for businesses to access the funding they needed to operate. Unemployment soared, and consumer spending fell, leading to a prolonged period of economic hardship. The Great Crash had significant implications for the United States and the world. It marked the beginning of the Great Depression, which lasted until the late 1930s and had a profound impact on the global economy. It also led to a widespread loss of confidence in the financial system, and many investors became more cautious in their investment strategies. The crash led to the implementation of new regulations and safeguards to prevent a similar occurrence in the future, including the establishment of the Securities and Exchange Commission, SEC. In conclusion, the Wall Street crash of 1929 was a catastrophic event that had far-reaching consequences for the United States and the world. The crash marked the beginning of the Great Depression and led to significant economic hardship for millions of people. The lessons learned from the crash helped shape the modern financial system and serve as a reminder of the dangers of unchecked speculation and risk-taking. The crude oil price shocks of 1793 and 1979. The crude oil price shocks of 1973 and 1979 were two significant events in the history of the global economy. These events marked a dramatic shift in the price and supply of oil, which had significant consequences for the global economy and politics. The first oil price shock occurred in 1973, when the Organization of Petroleum Exporting Countries, OPEC, imposed an oil embargo on countries that supported Israel in the Yom Kippur War. This led to a global oil shortage and a sharp rise in oil prices. The price of oil increased from $3 per barrel to $12 per barrel in 1974, leading to a period of stagflation in many Western countries. The second oil price shock occurred in 1979, following the Iranian Revolution, which led to a decline in oil production in Iran, one of the largest oil-producing countries at the time. This, coupled with political unrest in other oil-producing countries, led to a second wave of oil price increases. The price of oil rose from $13 per barrel in 1979 to $40 per barrel in 1980, leading to a period of inflation and recession in many Western countries. The oil price shocks of 1973 and 1979 had significant consequences for the global economy and politics. The Western countries, which relied heavily on oil imports, suffered the most from the oil price increases. Many countries entered a period of inflation, recession, and high unemployment. In the United States, inflation peaked at 14% in 1980, and unemployment rose to 10%. The oil price shocks also led to significant changes in energy policy and global politics. Many Western countries began to focus on energy independence, investing in alternative sources of energy and reducing reliance on oil imports. The oil price shocks also led to geopolitical tension, as Western countries attempted to secure stable sources of oil and influence in the Middle East. The oil price shocks of 1973 and 1979 also had a lasting impact on the global economy and politics. They prompted changes in energy policy, leading to the development of alternative sources of energy. The oil price shocks also highlighted the importance of stable sources of oil and their influence on global politics. These events contributed to a period of uncertainty and geopolitical tension that continues to impact the world today. In conclusion, the crude oil price shocks of 1973 and 1979 were significant events in the history of the global economy. They marked a dramatic shift in the price and supply of oil, which had significant consequences for the global economy and politics. The oil price shocks led to a period of inflation, recession, and geopolitical tension, prompting changes in energy policy and the development of alternative sources of energy. These events contributed to a period of uncertainty and geopolitical tension that continues to impact the world today.